Hello everyone. In this video, I will explain the basics of investing in bonds and how to earn higher returns from your investment. Now, let me show you something interesting. You might have seen similar ads in newspapers, social media, etc. This one is the ad for the public issue of Muthoot Finance debenture. It's coming up with an NCD with interest of 9 to 10%. And this is higher than the bank FD rates, and it was fully subscribed. But during the same period, a similar NCD was trading at a yield of 13%, and another one was trading with an yield of 19%. So in this video, I will be discussing how to invest in debentures and earn higher interest. You can apply this learning and use to buy bonds if you are not comfortable with investing in corporate debts, and still earn the higher interest. So what's bond and debentures? When a company needs capital, the easiest way is to take a bank loan. Here banks borrow capital from investor and gives money to the company. However, as the company grows and want to diversify the borrowing mix or to get a benefit of lower interest, the companies may opt to take loan directly from the investors via bonds or debentures. So basically, a bonds or debentures are essentially loans a company takes from the investor. Globally, loans which are secure are called bonds and the unsecured ones are called debentures. However, in India, all government borrowings are classified as bonds and corporate loans are classified as debentures. Due to this, we have secured debentures and unsecured debentures in India. When a loan is backed by an asset as collateral, it's called a secured debenture. So in case if company defaults, the investor could liquidate the asset and get some money back. Unsecured loans won't have any collateral linked to the loan, so it's considered to be more riskier than the secured loans, and it commands a higher interest compared to the secured debentures. Next, we will look at some common terminologies used in bond markets. The face value. The face value is the price of bond when it is first issued. Usually it's 1000, but we can see some debentures with face value as 5000 or even 10,000 as face value. The coupons. Coupons is the annual interest paid on bonds or debentures. It's calculated as a percentage of face value and it is paid at a predetermined intervals. Usually it will be monthly or annually. But you could even see some debentures with quarterly or half yearly as a payment intervals. And there are certain debentures like zero coupon bonds and debentures which pays back the interest and principal only on the maturity. The maturity date is the date when the company pays the principal back to the investor. The credit rating. All bonds and debentures creditworthiness has to be assessed by a credit rating agency at regular interval and assign a rating based on the creditworthiness. You might have heard about CRISIL, ICRA, CARE, and these are the credit rating companies in India. Based on the credit worthiness, they assign a ratings like a AAA, AA, AAA, BBB, D, etc. So AAA is the best, followed by AA, and D means it's the lowest. D means its company has defaulted or is expected to default. While credit rating is a great help, investors has to assess the credit worthiness and corporate governance levels standards of the company personally. as we had cases where the ratings of companies like DHFL was changed from AA to D in quick time. And in case of IL and FS, the rating was changed from AAA to D straight. Next is yield to maturity, which is commonly known as YTM. It measures the annualized return on investment if the bond is held to maturity. For example, a debenture with face value of 1000 and coupon rate of 10% and has exactly 1 year to maturity. If it's trading at 1000 rupees, its YTM will be 10%. It's same debenture. If it's with face value as 1000, coupon rate as 10, and if it has 6 months to maturity, and if it's trading at 1000, the YTM will be double. That's 20%. While the YTM calculation can be pretty complex, however, we have a formula in Excel called yield mat. We could calculate it very easily, or the websites, exchanges, and even the full service brokerage provides the YTM on the sites. The risks when we invest in, first is the credit risk. So that's the main one. When we invest in bank deposit, the banks lend capital to the companies. The bank is taking the risk. Usually banks takes a risk margin of 4 to 5%. Even in case company defaults, it will be banks who takes the hit. However, in case of bonds and debentures, risk will be with the investor. In case of defaults, the investor capital will be at risk. So it's very important to assess the company's ability to repayment. Next is the interest rate risk. If the interest rate has moved up, the investors may get stuck with a low yielding investment. Like 2 years back, the interest for the debenture was, a good debenture was 7%, around 7%. However, if you see the debenture for a AA rated company, it's near 10%. So if someone bought a debenture 2 years back, the person will be stuck with a low yielding asset. Now that we are done with the debentures, we will see how to get the details of debentures and where to buy it. We can buy debenture, bonds and debentures either at the time of public issue. During those time, you will see ads in newspaper or the promotions by the brokers. Or you can buy the bonds which are already listed. So just like shares, once the bonds and debentures are issued during the public issue, it will be listed and traded on the exchanges. While the liquidity may be low, the investors can look to buy the debentures which is getting traded below their intrinsic value. And we can get the details of debentures getting traded on both the exchanges BSE and NSE, and it has almost all the details. So this is the view of NSE, and it has all the informations like symbols, type of bond or debenture, then it's a coupon rate, YTM, the credit rating, maturity date. And we can even sort the details using any of the details here. The next is, this is the view of BSE. So we get almost similar information here, but the only problem is we can't sort the details. The links for both the sites are given below. But my preferred way of using is a full service broker like an ICICI Direct, because it not only provides all the details required, but we can also give the bid rate and see the change in the YTM. so it's more futuristic. So while buying bonds, the most important thing is the safety, because we are buying bonds for the safe returns. And whether the safety should be measured by the company's ability to the repay all the obligations. And when we calculate the ability, we should calculate based on the very conservative estimates. Don't calculate with the very rosy picture. And sometimes there may be a case like the company with usually the company with a lower rating will have a very high return. Sometimes it could be very tempting to buy such bonds, but we should resist those temptations, because it's in tough time those companies ability to repayment will definitely become a problem. So in coming videos I will put a video on how I screen a debenture and what all checks I do before I buy. If you like this, thank you for watching, and if you like this video, please consider subscribing to my channel. Thank you.